Welcome back to the Pro Ticker Podcast, your Thursday morning edition covering major financial magazine headlines, everyone.
Great to be digging into the sources you've shared. We're looking at headlines and market moves from Wednesday, June 11th and into Thursday, the 12th, 2025.
Yeah, and our goal today, as always, is to cut through some of the noise, pull out the key insights from this material, and help you get up to speed quickly on what's driving things.
Absolutely. We've got quite a mix. U.S. trade policy is front and center, naturally. Some economic data points, rising geopolitical stuff, the U.S.-China tech race, AI developments.
And even some interesting company-specific action looking at insider buying and sector trends, so quite a bit to unpack.
Let's dive right in. Maybe start with what seems to be the biggest worry for major investors right now, trade tariffs.
This really jumped out. There's a Schroders survey mentioned in the sources. They talked to nearly 1,000 top investors. We're talking people managing, what, $67 trillion?
Yeah, huge pool of assets. And the finding was pretty stark. 63%, nearly two-thirds, called trade tariffs their single biggest macroeconomic concern.
Single biggest. And apparently, that risk level was seen as 6 times greater than whatever came in the second place.
6 times. It's quite something. And keep in mind, this survey was apparently done back in April and May.
Right, so before some of the really recent back and forth we've seen this week, that level of anxiety was already there.
Exactly. Which leads us straight into the current uncertainty around President Trump's trade policy. Specifically, that July 9th deadline is coming up.
That's the end of the 90-day tariff pause he announced back on April 9th.
Right. And this week, we got sort of conflicting signals on what happens next. On Wednesday, Treasury Secretary Scott Bessent was testifying.
Before the House Ways and Means Committee.
Yes, and he signaled some openness to extending that pause, but only for certain partners.
He mentioned 18 important trading partners, didn't he? Said if they're negotiating in good faith, it's highly likely the date could roll forward for them, like the EU maybe.
But, and this is the key part, not for those who aren't negotiating.
Oh.
So a potential split there.
Okay, so that sounds like, some room for maneuver for allies or active negotiators. But then also on Wednesday.
Also on Wednesday, President Trump himself chimed in, saying he'd be sending letters out, maybe in a week or two, setting unilateral tariff rates.
Unilateral rates, basically a take it or leave it deal is how it sounds. He was quoted saying something like, at a certain point, we're just going to send letters out saying this is the deal.
So you see the conflict. Bessent hints at negotiation and extensions for some. Trump talks about imposing terms.
Right.
That's confusing for markets.
No kidding. And specifically on China, Commerce Secretary Howard Lutnick tried to add some clarity, saying current U.S. tariffs on China won't change again.
Yeah, he clarified that the 55% total figure Trump mentioned before isn't new tariffs on top of old ones. It's the existing duties plus the additional ones already imposed.
Okay, so clarification on the current number. But the threat of new unilateral race or the pause ending for some countries, that keeps the risk high.
Right. And speaking of China, there was also that mention of a framework trade agreement, or a truce, that was apparently negotiated in London earlier this week.
The one involving China supplying rare earth minerals, while the U.S. keeps the 55% tariffs. Trump called it a done deal pending approval.
Exactly. But even with these sort of hints of deals or clarity, the market reaction wasn't exactly euphoric. U.S. stock futures were down Thursday morning. Dow, S&P, NASDAQ futures all slipped.
Asian markets were mixed too, weren't they? Nikkei down, Kospi up, Hang Seng down, China mainland flat, Australia down.
It really seems like investors are, as one source put it, growing wary of taking trade pronouncements at face value. There's been a lot of noise.
You can understand why. And it's not just the immediate market reactions. Seema Shah over at Principal Asset Management made a good point about inflation.
What was that?
That even if tariffs go up, the price increases might not actually show up in the CPI data for months. So it's maybe premature to assume that the price shock will not materialize.
That's a critical point, the delayed impact. So even if current inflation looks okay, this tariff uncertainty could still mean problems down the road.
And this isn't just a U.S.-China thing, right? The sources mentioned Japan's manufacturer sentiment hitting its lowest point since early 2024 because of these global trade worries.
Yeah, it's creating headaches for the Bank of Japan, too, as they're trying to move away from their super loose monetary policy. One former BOJ official even suggested these U.S. tariff threats might have actually stopped the BOJ's rate hike plans for now.
Wow, so the ripple effects are definitely global. And one last piece on trade. That federal appeals court ruling.
Ah, yes. They basically put a temporary hold on a lower court's decision that had questioned the way Trump imposed some tariffs, calling it unlawful. So for now, the tariffs stay, legally speaking.
Okay, that's a lot on trade. Let's maybe broaden out a bit to the general macro picture and how markets are digesting that alongside all the trade stuff.
Sure. Well, U.S. Treasury yields were pretty calm Thursday morning. The 10-year yield ticked up just a tiny bit, but 2-year, 5-year, longer-dated stuff was mostly flat.
And just a reminder for everyone, bond yields and prices move in opposite directions. So flat yields mean bond prices were pretty stable.
And speaking of bonds, there was a big $39 billion 10-year Treasury auction recently. Analysts seem to think it showed healthy demand. Some even called it strong.
Healthy demand, even with all this uncertainty swirling around.
Apparently so. The bid-to-cover ratio was maybe a bit mixed compared to the last year, but overall it suggests investors are still willing buyers of U.S. debt right now.
Interesting. What about the latest economic data points? CPI came out.
Right, the U.S. Consumer Price Index, it actually came in a little softer than expected, up just 0.1% for the month versus forecasts of 0.2%.
Core CPI too, right? Excluding food and energy, also less than expected.
Exactly. Annually, headlines TPI was at 2.4%, core CPI at 2.8%. So inflation looks relatively contained, at least in this report.
And this came after May jobs data, which, okay, the headline number was better than expected, but they revised March and April figures downwards, which suggested, maybe some weaknesses in the labor market creeping in.
So you put those together, slightly softer inflation, maybe a little wobble in the job market. Normally, what does that make you think?
Rate cuts, right. You'd think the Fed might start leaning that way.
Usually, yeah. But like we keep saying, these aren't normal times. That big cloud of trade uncertainty hanging over everything, it really complicates the picture for the Fed.
How can they cut rates if they're worried about a potential inflationary shock from tariffs hitting down the line?
Precisely. It ties their hands, or at least makes the decision incredibly difficult, adds another layer of uncertainty for everyone else trying to guess their next move.
And then there's the government's own finances. The U.S. budget deficit for May. It was huge, $315 billion.
Yeah, completely reversing the surplus they had in April, which is typical due to tax season. The year-to-date deficit is now up to $1.36 trillion.
Which is, what, 14% higher than the same period last year?
Correct. And a big driver of that widening gap, surging interest costs on the national debt.
Over $36 trillion in debt now. The interest payments alone were $92 billion just in May. That's staggering.
It really is. And tied into this, remember, the U.S. hit its $36.1 trillion debt limit back in January. That has knock-on effects, like shrinking the supply of Treasury bills, which money market funds really rely on.
So the debt limit isn't just political theater, it actually impacts market plumbing and liquidity.
Definitely. So despite, the softer CPI print and maybe some tiny hints of trade progress, U.S. stocks actually fell on Wednesday. S&P 500 and NASDAQ broke their winning streaks. Dow was flat.
Suggests investors are still pretty cautious weighing all these different signals.
It seems that way. Okay, let's shift gears again. Another big factor adding to the uncertainty, rising geopolitical tensions, particularly in the Middle East.
Yeah, the sources mentioned the U.S. ordering some non-essential staff out of the embassy in Baghdad and also authorizing voluntary departure for military families in the region.
Right, and this came after Iran apparently threatened to hit U.S. assets if Iran itself was attacked over its nuclear program.
And this is all happening just before U.S.-Iran talks scheduled for Sunday in Oman, right?
Correct. The timing is notable. And the market reaction was pretty swift, especially in oil.
Oil prices jumped over 4% on Wednesday when those initial reports about evacuations came out.
They did pull back a bit on Thursday morning, with Brent under $69 and WTI under $68, but they were still up about 4% for the week overall.
And the fear is always disruption, isn't it? Especially through the Strait of Hormuz.
Exactly. That's such a critical choke point for global oil shipments.
Yeah.
Any hint of instability there sends oil prices higher.
And when tensions rise like this, where do investors often look? Gold.
Yep, gold was up for a second day, getting close to $3,373 an ounce, acting like that classic safe haven.
Responding to the Middle East situation, but probably also the trade uncertainty we talked about, like Trump's unilateral tariff threats.
For sure. It adds to gold's already strong run this year, up about 28% year to date. Central banks buying has also been a big support.
Okay, let's pivot now to technology. Specifically, the U.S.-China tech race and some of the AI developments highlighted in the sources.
It's pretty clear U.S. export controls are really shaping this landscape. They're pushing China hard to build its own AI chip capabilities.
Which is a double-edged sword, right?
Yeah.
It forces them to innovate domestically, but also creates huge hurdles.
Definitely. On the chip design side, China seems to be making some real progress. Huawei's Ascend 910B chip is mentioned as being quite capable.
And the next version, the 910C, might only be about a year behind the kind of NVIDIA chips the U.S. restricts exports on, like the H20.
Potentially, yes. And remember, the H20 itself was a step down from NVIDIA's top-tier H100, designed specifically to meet export rules, but it was still better than China's domestic options at the time. So Huawei closing that design gap is significant.
But the sources really emphasize the manufacturing part is still the major bottleneck for China.
Absolutely. It comes down to that incredibly complex equipment, especially advanced lithography tools, like the EUV machines from ASML in the Netherlands.
You need those for making the most advanced chips below 7 nanometers efficiently and reliably.
In China's top foundry, SNEX, they're sort of stuck at 7 nanometers using older DUV technology, which works, but the yields, the number of good chips per wafer, are apparently poor compared to TSMC, the world leader who uses EUV. And getting beyond 7 nanometer without EUV is extremely difficult and costly for mass production.
Plus, the Netherlands restricts selling those EUV tools to China, so that's a major roadblock.
It is, and it's not just the main processor chips. China's also behind in high bandwidth memory, HBM, which is crucial for AI.
The sources mention a Chinese company, CXMT, is starting HBM production, but they're maybe 3 or 4 years behind the leaders like SK Hynix and Samsung.
That's the estimate, yeah. And again, they face hurdles getting the necessary manufacturing equipment due to export controls. It shows China's reliance on foreign tech persists across that supply chain.
This whole situation led to some pretty direct comments from NVIDIA's CEO, Jensen Huang.
Yeah, he warned that if the U.S. essentially pulls back from engaging with China's market, then Huawei could end up dominating not just in China, but potentially globally, too.
His point was about the ecosystem, right? He stressed getting AI developers worldwide to build on the American tech stack. If all the developers end up in China using Chinese tech,
Then the China stack is going to win, as he put it. It highlights that risk of inadvertently creating a powerful, independent competitor by cutting off engagement.
fascinating strategic dilemma. Now, shifting from the hardware race to AI's future, OpenAI's Sam Altman had some pretty bold takes mentioned in MarketWatch.
He did. He suggested we might have already passed the point where AI surpasses human intelligence in some ways, called it the event horizon, where the takeoff has started.
Wow. He thinks current systems are already smarter than us in many aspects, used by hundreds of millions daily.
And his predictions get even bolder. Systems with novel insights next year, robots doing real-world tasks by 2027, and intelligence and energy becoming wildly abundant by 2030.
Those are some incredibly fast timelines. Really makes you think about the pace of change.
It really does. Okay, so from those big macro and tech trends, let's maybe zoom in on some specific investor strategies and company stories that came up in the sources.
There was an interesting point from Bank of America strategist Savita Subramanian about following insiders.
Yeah, her take is that tracking company insiders, executives, directors buying their own company stock can be a better source of ideas than just following hedge funds. She calls insiders the smartest money.
Because they know their business best, presumably.
Yeah.
And she noted that when insiders buy heavily, especially after the market sells off, those stocks tend to outperform later on, generate alpha.
Right, and insider buys has to be reported publicly so you can track this activity. One source highlighted 4 companies with significant recent insider buying. First up was Wynn Resorts, WYNN.
Right, the casino operator. Saw about $31.5 million in buys since February, mostly from Tillman Fertitta, the billionaire owner, and a couple directors.
And the re there is bullishness on their expansion, like the project in the UAE, and maybe a bet that fears about recession or tariffs hitting consumer spending are overdone. Plus, it apparently trades at a discount to its peers.
Okay. Next was Occidental Petroleum, OXY. Warren Buffett's favorite oil play, it seems.
Yeah, Berkshire Hathaway bought another $35 million worth this year, but that's part of a huge $6.9 billion stake they've built over 3 years. It's now Berkshire's 7th largest holding.
And the thinking there, partly a bet on higher oil prices, maybe linked to that idea of the taco trade that if Trump eases off tariffs, growth in energy demand could pick up. OXY is also about strong cash flow, selling assets, paying down debt, trades at a slight discount to its historical average price-to-sales ratio.
Then J.B. Hunt Transport Services, JBHT, the trucking giant.
They had a director buy $10 million back in February, and the COO bought about $400,000 in April.
That's seen as insiders betting that the market's worries about recession and tariffs hurting trucking volumes are maybe overblown. And again, the stock's trading at a notable discount to its 5-year average PS ratio.
And the last one highlighted was Estee Lauder, EL, the cosmetics company.
Yeah, a director made a big $8.7 million purchase in February, following a nearly $25 million buy last November. The CFO made smaller buys, too.
That sounds like a signal of confidence and a turnaround, maybe.
That's the interpretation. They've got new management, launching new products, exploring new channels like Amazon and TikTok, cutting costs pretty aggressively, apparently 20% of middle management jobs, and managing tariff risk by shifting manufacturing out of China. And like the others, it's trading at a deep discount to its historical PS average.
So, interesting theme there. Insiders buying beaten down stocks in sectors sensitive to economic or trade concerns.
Exactly. Beyond those, a few other stocks were moving on specific news. Oracle, or RCL, shares jumped, nearly 8% pre-market Thursday?
Yeah, after they raised their revenue forecast pretty significantly for fiscal 2026, citing really strong demand for AI-related cloud services. They also announced that big joint venture with OpenAI, Stargate.
On the other side, GameStop, GME, was down sharply on plans to offer convertible notes, and Boeing, BA shares, fell after the nominee to head the FAA promised strong oversight following the 737 MAX issues.
Overseas, Qantas shares got a boost after deciding to shut down their budget carrier Jetstar Asia due to tough competition.
And one more potentially big deal brewing. Chinese gaming giant Tencent is reportedly looking at acquiring Nexon, the $15 billion game developer.
Tencent already partners with Nexon on some games, right? This would be a major move to strengthen their gaming portfolio, especially after some recent investments in South Korean entertainment.
Definitely one to watch. And that actually leads nicely into our final theme, this broader trend of Chinese companies expanding globally, even with all the trade friction.
Yeah, the sources point out they're not just sitting back, they're actively pushing into the U.S. market and building brands worldwide.
It seems like a shift from just being the world's factory or relying on joint ventures to really building their own international presence, setting up regional offices, hiring locally.
There was a great example, Insta360, the camera company. They just had a big IPO in Shanghai, but the U.S. is one of their largest markets, generating revenues similar to China and Europe combined.
And the co-founder sounds pretty optimistic about continued U.S. demand.
And it's not just them. Roborock, the robotic vacuum maker planning a Hong Kong listing, gets over half its revenue internationally. Hisense wants to be the top TV seller in the U.S. Companies like BC Baby Care and Pop Mart Toys are also making big pushes overseas.
Pop Mart's overseas sales growth was staggering, like 373% in 2024. They're opening stores in the U.S. now.
So, partly driven by slower growth at home in China, maybe, but clearly a strategic global push despite the headwinds.
Well, we certainly covered a lot of ground today. From that investor anxiety over trade
To the details of AI chips, market reactions, geopolitical jitters, specific stock stories.
it really paints a picture of a global financial landscape shaped by this complex interplay of forces, trade talks, economic data, tech breakthroughs, regional tensions. It's all connected.
Absolutely. What really stands out is how a comment from the Treasury Secretary about tariffs, a CEO's warning about tech competition, and a toy company expanding in the U.S., they're all part of the same interconnected story.
It definitely is all linked. Which brings us to a final thought, maybe something for you, our listeners, to chew on.
Yeah, in this environment where trade rules, tech dominance, and geopolitical stability seem constantly in flux, how does all this ongoing, evolving uncertainty shape your own long-term perspective? How does it affect how you view different sectors, different investment opportunities moving forward?
Something to consider. It's a dynamic world out there.
It certainly is. Well, that's our deep dive for today, based on the sources you provided. We'll be back tomorrow morning with new headlines from major financial magazines.
See you then.